Hello friends, in the last lecture we were discussing about the super profit method for valuation of goodwill. The super profit method is the excess of profits earned by an enterprise over its normal return on capital employed. Right? Whatever is the normal rate of return in the market and what we are actually earning, the difference between the two is super profit. Super profit means the earnings are actually more than the expected return, right? For that we calculate capital employed, average capital employed. Average capital employed is opening capital employed plus the closing capital employed divided by 2. And how to calculate capital employed? I told you capital employed is either capital plus free reserves minus the fictitious asset, or it is all assets minus goodwill if any, minus the fictitious asset, minus the non-trade investments, and minus the outsiders liabilities, right? Then we have to calculate the actual profits. First of all, we'll calculate normal profits. Normal profit is expected profit, that is average capital employed into normal rate of return. Then we will calculate the actual average profits and we'll calculate the super profits by subtracting them, and the goodwill is super profits into number of years purchase, right? Clear? This is super profit method of valuation of goodwill. Now let's see some practical problems on this. See, the first practical problem is a firm earned net profits during the last 3 years as 18,000, 20,000 and 22,000, right? The capital investment of the firm is 60,000. A fair return on the capital having regard to the risk involved is 10%. That is the normal rate of return available in the market. Similar business earning a return in the market. Calculate value of goodwill on the basis of 3 years purchase of average super profit for the last 3 years, right? Let's start. We'll be doing problems on super profit method. Now, first of all, we have to see what is the capital employed, right? We are given the capital employed, average capital employed as 60,000, right? The capital investment of the firm is 60,000, right? Then what is normal rate of return? Normal, that is expected return. This is the return which a similar business in the market is enjoying, right? This is 10%. So what will be the normal profit? Normal profit will be 60,000 into normal rate of return. This comes to 6,000. Now let's see, the next we have to calculate is average profits. Actual average profits. We are given profits for 3 years as 18, 20 and 22. We'll take the average of this. 18,000 plus 20,000. This comes to 60,000 divided by 3. 20,000. So see, actually we are earning 20,000 and the normal rate of return on the capital employed is 6,000. That means because of our goodwill, because of our reputation, we are earning more than what is a similar business in the market is earning, right? I am repeating again, we are earning more than what is a similar business is earning in the market, and why we are earning more? Because of our goodwill, right? So what will be the super profits? Super profits will be average profits minus normal profits. So what are the average profits? Average profits are 20,000. These are the actual profits. And what are the expected or the normal profit? 6,000. That means rupees 14,000 we are earning extra, more than the expected. And what is goodwill? Goodwill is equal to super profits into number of years purchased, that is 3. Right, so this comes to rupees 42,000. Now this is the goodwill. Clear? First of all, we have capital employed, which is already given in the question. We have normal rate of return given, that is the return a similar business is earning in the market. We'll calculate the normal profits, and we will calculate the actual profits that we are earning, the average actual profits we are earning, and we will see what extra we are earning because of our goodwill, because of our reputation in the market, right? So that are super profits. Clear? And goodwill is super profits into number of years purchase. Clear? Let's move on to the next practical problem. Next problem says average net profit of XYZ Limited expected in the future is rupees 54,000 per year, right? The average capital employed in the business is 3 lakh. Normal profit expected from capital invested in this class of business is 10%. The remuneration of the partners is estimated to be 9,000 per annum. Find out the goodwill on the basis of 2 years purchase of super profits. First of all, let's see the capital employed. Capital employed, we are already given how much? 3 lakh. Right? Normal rate of return, normal rate of return is 10%. So we can calculate normal profits. Normal profits is equal to capital employed into normal rate of return divided by 100, and the capital employed here is 3 lakh into 10 divided by 100. This comes to rupees 30,000, right? So we have calculated normal profits. Next we want to have average profits. See, it is given in the question that average profits are expected to be 54,000, but out of these 54,000 we have to pay remuneration to partners. How much? 9,000. So the actual average profits are, these are the actual average profits, 45,000. Now we'll calculate super profits is equal to average profits minus normal profits. Average profits we have 45,000. And what are the normal profits? Normal profits we have 30,000. That means we'll be earning 15,000 extra because of our goodwill, because of our reputation. Now goodwill is rupees 15,000 into 2. So 30,000 is the goodwill. Right? Clear? This is how we'll be calculating goodwill under the super profit method. Clear? We'll first see whether we are given the capital employed. We'll see the normal rate of return, which will always be given. Then we have the normal profits we can calculate. And from there we'll calculate average profits and super profits. Right? Let's move on to the next problem. Next problem is, on 1st April 2014, an existing firm had assets of 75,000, including cash of 5,000. Right? The partners' capital accounts showed a balance of 60,000 and the reserve constituted the rest. Clear? If the normal rate of return is 10% and the goodwill of the firm is valued at 24,000 at 4 years purchase of super profit, find out the average profit of the firm. Now what we have to find is, we have to find out the average profit of the firm. This is a reverse working question now. Right? First of all, we have goodwill, we have number of years purchase. We can calculate super profits. Let's see how to do this. First of all, we have goodwill is equal to super profits into number of years purchase. Now we have the value of goodwill, we have number of years purchase, we can calculate super profits. How much is the goodwill? 24,000. Number of years purchase 4. Goodwill is 24,000. Super profits into 4. So super profits will be 24,000 divided by 4,000. This comes to rupees 6,000. Clear? Now let's see. We have, it is given the partners, an existing firm had assets of 75,000 including cash of 5,000. This means we have the capital employed of 75,000. Clear? Out of 75,000, 60,000 is the capital and rest 15,000 is the reserve. Right? Clear? So we have capital employed and the normal rate of return given is 10%. What is capital employed? Capital employed is 75,000. Out of this, 60,000 is capital and 15,000 is free reserves. Right? And 5,000, the cash is just given to confuse you. Right? Because cash is also an asset. Cash is neither goodwill nor fictitious asset, not the non-trade investment. So we will include cash, obviously. It is included in 75,000. Right? So we have the capital employed of 75,000. Normal rate of return is given at 10%. So what are the normal profits? Normal profits will be 75,000 into 10 divided by 100, 7,500. Right? Now, what is the formula for super profits? Super profits this is equal to average profits minus normal profits right. We have super profits as 6,000. We have to calculate average profits, and we have normal profits of 7,500. So what are average profits? We have average profits of 6,000 plus 7,500. This comes to rupees 13,500. So this was a reverse working that we have to reach at average profits. First of all, we'll calculate what are the super profits, what are the normal profits. We'll calculate. We are given capital employed, right? Okay, then we'll reach at average profits as super profits plus the normal profits. Okay, clear? Let's see the next problem. The next problem is the average profit earned by a firm is 80,000, which includes undervaluation of stock of 8,000 on an average basis. The stock is undervalued by 8,000, right? The stock should be 8,000 up. If the stock is 8,000 up, automatically the profit will be up by 8,000. If you remember trading account, right? If the stock is up by 8,000, the profit will automatically be up by 8,000 because we have the asset of 8,000 more, right? The capital invested in the business is 8 lakh and the normal rate of return is 8%. Calculate goodwill of the firm on the basis of 7 times the super profit, right? So let's see. First we'll calculate capital employed. Capital employed we are given in the question. Capital employed is 8 lakh. What is the normal rate of return? It is given as 8%. So what are normal profits? Normal profits are capital employed into normal rate of return divided by 100. This comes to rupees 64,000. Now see the actual average profits. Average profits. How much we are given the average profits? Average profits are 80,000, but there is an undervaluation of stock of 8,000. That means the actual profit should have been up by 8,000. 80,000 add back undervaluation of stock. This is 8,000. So the actual profits are 88,000. Clear? Now we have normal profits of 64,000. We have average profits of 88,000. We can calculate super profits. Super profits is equal to average profits minus normal profits. What are the average profits? 88,000. What are the normal profits? 64,000, right? So that means 24,000 are the super profits. Clear? Now goodwill, it is given in the question that 7 times the super profits. Super profits of 24,000 into 7. This comes to 1,68,000. This is goodwill. Clear? Very simple problems, just few points that you need to understand carefully. We need to calculate what are the normal profits, that is the normal rate of return. We have to calculate what are the actual profits of the business. Now undervaluation of stock will reduce the profits, so we will add back the undervaluation of stock to reach at actual profits, right? See, if there is an overvaluation of stock, then the profits reflected will be high. We will subtract overvaluation of stock. If there had been overvaluation of stock, then we would have calculated the profits as 80,000 minus 8,000. 72,000 would have been average profits in case of overvaluation of stock. Clear? So this way we have calculated the average profits and then the super profits and goodwill, right? This was the last problem on super profit method of valuation of goodwill. Clear? I hope you all must have noted this down. These are very simple problems. This is a very simple chapter, goodwill. The only thing you need to understand is the concept behind it, right? What is goodwill, how we are calculating, why there is a need for goodwill. You have to understand all these things, right? Just keep in mind one thing, goodwill is reputation. We are buying reputation, we are generating self-generating reputation. How to value it, right? The different methods of valuation and the logic behind it. Clear? So we have done 3-4 problems here. I'll take you to the last one. This is the last one.